Hello, good morning, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Tell me, please. Can you hear me? All right, that's great. Okay, just one thing I want to know that how many of you are attending their first class today? Means they were not present in the last class. Just text me, please. How many of you are attending their first class today? Yes, please. Okay, the first person. One person. Okay, two. Right. All right. Okay. So students, in the last class, we have talked about the concept of assurance engagement. And the first introductory topic we covered in the last class. Today itself, we are going to proceed from the same, the topic which was we were left in the first chapter. Tell me one thing. Have you found the notes volume 1? Notes volume 1, have you been able to download? Tell me, please. Okay, one thing I just wanted to tell you that there are some torrential rains here. Okay, so sometime if I get disconnected from the class, stay here. I will rejoin. Okay, so that's you should be aware of first place in the first place. Okay, now so it's good that you have been able to download from the website and students, let us proceed and talk about the topic is limitations of audit. This is the volume 1. We have covered all these topics almost. The topic is limitations of audit. That what are the limitations of audit? So then auditing, we talked about in the last class that auditor is the examination of financial statements. And the purpose of audit is that auditor gives report on financial statements of the company. This is what we talked about in the last class. Now, what are the limitations of audit? Limitations of audit are, the first limitation is auditing is subjective. Subjective means the judgments are involved in the auditing process. Judgments are involved. At the number of stages of audit, auditor has to make judgment, make decision as per his opinion. And judgment means where there is no 2 plus 2 is equal to 4. When there is no 2 is equal to 2 plus 2 is equal to 4, there is a problem. It means the chances of errors are there. Chances of mistakes are there. When there is no clear means that rule where judgment has to be made. So chances of errors are there in the audit process. And then sample-based testing. Auditor performs sample-based testing. He does not check all the items. So on auditor select sample of the transaction, sample of financial statement items, and then on the basis of that draws a conclusion. So sample selection may be wrong as well. So it's a sample because the conclusion drawn on the basis of selected sample that may be wrong as well. Now, next point. The next point is, yes, audit report. Just see here. Student, this is the year end. For example, 31st December is the year end. Audit report is issued normally 3 to 4 months after year end. That means end of March, April. So audit report is issued in this area. And you know that when audit report is being issued, after some time has been elapsed, and this report is related to previous year financial statements. And you know that this usefulness of the report reduces the longer the duration. You know that we are getting report about financial statements which are related to last year after 3-4 months. Decrease usefulness. And the next is the audit report. I will teach you how audit report is prepared. What are the standard words used? Standard heading used. There is standard format of the report, standard wording. And when audit report has a standardized format, standardized wording, it means that audit report may not cover all the issues which should have been covered. Yes, standard issue means that you cannot include words other than those standard words. You cannot cover issues more than what the standard report says. Standard format, standardized defined format, and there might be problem. So audit report has inherent limitations. Standardized format, which may not cover all the relevant. And last point, audit evidence. Audit evidence means proof. The audit evidence auditor obtains about financial statement items, that is sometime indicate what is probable, not certain. Evidence is persuasive, another word, not conclusive. What does it mean? So then audit of the financial statement is done after the year end. After the year end. And when it is done, so the point is, you know that, for example, we are checking an item at the end of year. The transaction was done in June. So what we will see? We will see relevant invoice, relevant documentation, and we'll say, yes, it is probable that it has been occurred. Probable. Because 6 months, the transaction which occurred 6 months before, we cannot give a 100% guarantee sometimes that it occurred. We just see the documentation around that and say, okay, yes, it looks like it occurred. This transaction processed. So we cannot be conclusive. We cannot be certain. Again, this is the drawback. Students, tell me please, this limitations of audit, is this clear to you people? Tell me. How many of you are unable to find notes? Tell me. I will help you. How many of you are unable to find notes? Notes. Volume 1. All of you have found? No, you have not downloaded, but you know where they are. You know where they are. Okay, that's your choice then. If you have not downloaded, I'm just asking how many of you have not been able to. Some people may not know where they are. Okay, right. Let us proceed further. There is once I have explained true and fair already. There is a topic materiality. Yeah, I think you were not present in the last. You were not present in the last class. Let me explain. You go to the website first of all. If you open the website, first page, home page, Hamzah Academy, this will open. Simply come December 2022 and find your batch here. Audit and Assurance batch A. Here it is. Click it. Curriculum. Here there are notes. Volume 1. Volume 1, you click. Everything is here. Even the video is also there. The first lecture video. The lecture 1 video is also there. You can simply click it and you can download it then from there. I hope you got the idea. Now, the next point is materiality. Students, when we see the wording of audit report, the audit report wording is like that. Financial statements of company give true and fair view of company affairs in all material respects. Material respects. Material. The word is used. What is material? Material means significant respects. They are not saying the financial statements are showing the 100% same affairs of the company. They're not showing that. They are not saying that. They say significant aspect, financial statements are showing the company correctly. In the significant aspects, important aspects. I'm repeating this, they are not saying the financial statements are 100% reflecting the affairs of company. They say in significant aspects, they are reflecting the company. They are saying that. So when we talk about material or materiality, so what is materiality? The relative significance of information in a particular context. You have studied the definition of materiality, that where in that 3, the omission or misstatement which can affect the financial statement decision, decision of financial statement user. Now, so just see here, 500,000 rupees, their significant amount. Significant? You say yes, it is. But are they significant for Cristiano Ronaldo? No. Are they significant for Steve Jobs? Late? No. Mark Zuckerberg? No. So it means significance is always relative. Are they significant for the winner's company? May not be significant. The winner's store may not be. Are they significant for Adidas? May not be. But yes, they might be significant for some small business. Some small business, they might be significant. So when we talk about materiality, so they are material for some business, but not material for some. So that's why when we talk about materiality, yes, significance and importance in the context of specific financial statements. Yes, an item may be material for one company. Yes, a matter is material if its omission or misstatement would influence the, yes. If I get to know Coca-Cola has a loss of 500,000, I say not a big deal. But if I come to know that a local burger shop or the local pizza shop, they have loss of 500,000, I say, oh, it's huge. So my decision is getting affected. When I talk about a local burger shop or the pizza shop, so it is material for the pizza shop or the burger shop, but not for the Coca-Cola. So my decision is affected. So it is material over there. If it is omitted or it is misstated over there, 500,000, if it is omitted in the financial statement of a small company, it is material. It is omitted in the financial statement of big company, it may not be material. Materiality can be quantitative. Quantity means amount. Materiality by amount. Materiality by amount. That amount involved is material. So 500,000 is amount. We are talking about quantitative materiality right now. Qualitative aspect. What is qualitative? For example, a company breaches a law, got penalized for 50,000, small amount for company. But the nature of information is material, that it is breach of law. It's non-compliance. So qualitative aspect is high. Qualitative aspect. Although quantity is not material, qualitative. The nature of information, that materiality due to nature of information. To nature of information. Materiality due to nature of information. Yes. So we have covered everything from this chapter now. So the next topic is statutory audit and regulation. Students, in the UK, yes, small companies are exempted from audits. They need not to conduct audits. Small companies are owner-managed businesses normally. owner managed. Means owners are themselves running the business, small companies. Yes, so audit is not for, because we talked about in the last class, audit is required there where owners are not, where there is agency problem, if we remembered the last class. Yes, small companies may hire audit firm for tax advice, for accounting advice, for finance advice, but not for audit, because owners are running the business themselves. And second, it is not cost beneficial for them. It is not cost beneficial for them, because the cost of audit is high, the benefits derived from that are low. And this company, small companies have no wider impact on the economy. If something goes wrong over there, economy is not disturbed. Impact is not this too high. Now, students, let us come here. Regulation of audit. Yes, we will be talking about the regulation of audits. So, audit regulation, what is meant by regulation? The word regulation. Regulation means direction, control, monitoring, review. Yes, direction as well, that how you will perform work. That is called regulation. Now, so regulation of audit is done. So why to regulate audits? Why to control auditor and audit profession? Why to direct them? Student, the answer I gave yesterday. Yesterday means last class. That since auditor's report is relied upon by so many people, shareholders of the company, they make decision, financial statements have been properly prepared or not. And then they make investment decisions. That is relied upon by the banks, that whether to give loan to the company or not. So audit report is relied upon by so many stakeholders of the company. So many. So if auditor does not work properly, what will happen? All those stakeholders will be misguided. That's the point. All the stakeholders will be misguided. So that's why it is important to regulate audit, that auditor work properly, so that all stakeholders are not misguided at all. So regulation of audits is done from two sources. Regulation of audit is done from two sources. Number one, regulation is done by national laws and regulation. National laws and regulations. The first source to regulate audits. So national laws and regulations, they define eligibility criteria for audits. They define eligibility criteria for auditor. Now, what is eligibility criteria? Eligibility criteria means who can act as auditor in the country, who can issue an audit report, what is the qualification, what is the experience, and what is the recognized supervisory body. What are recognized supervisory bodies? RSB. RSB. What is meant by this? RSB means that those bodies which are recognized, whose member can audit the financial statement. For example, ACCA is an RSB. ICAW is an RSB because their members are allowed to audit the financial statements. So recognize supervisory bodies, who they are. Now, let us proceed further. So national laws and regulation define these things. National laws and regulation define how the auditor is appointed, appointment, and removal of auditor. What is the process? Students, appointment of auditor is done by three sources. Number one, it is the right of shareholder to appoint the auditor first. The company's auditor is appointed by shareholders. Remember, appointed. Then, second, by directors. When directors appoint shareholder in two cases. Number one, first auditor of company. What is meant by it? First auditor is that auditor which is appointed in the first year in the life of company. The company formed newly this year, so auditor is appointed newly. The first auditor of company. Second point. When shareholders does not appoint, do not appoint. Yes. If shareholders do not appoint auditor of company, then who appoints? Directors appoint the auditor of company. Directors appoint the auditor of company. Then third, Secretary of State. When they appoint the auditor, when directors and shareholders don't appoint auditor, then who has the right? Secretary of State. Now, next. Removal or resignation of auditor. Resignation is auditor resigns. So I don't want to be your auditor. Removal, company removes auditor. Okay. Now let me take you to the notes. Here is the appointment I have discussed. Removal and resignation. Okay, come here. I will not write this much. You all have notes already. Now, so removal of auditor. Resignation. Auditor resigns himself. He says, I do not want to be your auditor and I want to speak to the shareholders. He can do in writing resignation. Forced removal. Sometimes shareholders, they decide to remove auditor. So shareholder pass an ordinary resolution, means ordinary more than 50%. Shareholder vote against the auditor, that auditor should be removed. So he has to be removed. Third case is 1, 2, and third. Student, these two are happening during year when auditor is working. This is at year end. At the end of audit. Auditors say, I have audited you previous year. Next year, I will not like to be your auditor. Simple as that. Auditor does not want to seek to re-election. Don't re-elect me. Don't reappoint me. Yes. Auditor decline. Remember key points. These are very important key points. Directors cannot remove auditor themselves. It is a shareholder they remove. Auditor can be removed simple majority. Simple majority means ordinary resolution, more than 50% votes. At general meeting, shareholders meeting. And auditor has right to attend such meeting, speak at the meeting. And a statement of circumstances when auditor is going to resign or going to be removed. Auditor has the right to submit, you know that auditor is going to resign. Why you are going to resign? Anyone ask? He said, this is the reason. So statement of circumstances. That this is the reason I am leaving. Or they say, no, this is my personal matter. Okay, you can submit. There is no such circumstances. Or the management is removing auditor. Company is removing auditor because of some allegations. They are not satisfied with auditor. So again, auditor wants to submit his version. That listen to me, what I say on the issue. So again, auditor has a right to submit the statement of circumstances. Auditor can request an extraordinary general meeting. Auditor can request shareholders meeting. They call it, I want to speak to shareholders. So they have the right to request management to do that. Now, let us proceed further. Now, the next point is, students, we have talked about appointment and removal of auditor. Now, regulation of audit we are talking about. There is another source, the auditor is regulated, that is called IFAC, International Federation of Accountants. International Federation of Accountants. IFAC. It is an international organization. And accountancy bodies are member of it. Like ACCA is its member. More than 140, I think, accountancy bodies. They are its member. So IFAC, it also regulates audit. IFAC has two subcommittees. Multiple subcommittees, but here we will talk about two only. One is called IAASB, International Audit and Assurance Standards Board. International Audit and Assurance Standards Board. This is a subcommittee of IFAC. What does it do? You know, they're regulating audits. How it regulates audit? How it regulates audit? It basically issues, revises, number one, multiple things. We will talk only few. ISAs, International Standards on Auditing. ISAs. It issues international standards on auditing. What these standards are? These are guidelines to conduct audit. That how audit has to be conducted. How audit has to be conducted. These are guidelines that how audit is to be conducted. Yes. You see, auditor is being regulated. Second, they issue, revises ISQCs, International Standards on Quality Control. And what they are for? They are guidelines to ensure quality of audit. You see how audit is being regulated. I told you audit is being regulated. And so they issue so many other guidelines. Two are only relevant to us. Now, let us proceed further. Another subcommittee of IFAC is IESBA. What is it? It is International Ethics Standards Board for Accountants. Subcommittee of IFAC. Another one. What does it do? This subcommittee of IFAC, it issues and revises codes of ethics. You have studied ACCA codes of ethics. Same. That how auditor should be have conduct, how the conduct should be. Now, next, let us proceed further. Let us proceed further. Students, is it clear so far? This regulation of audit, tell me. Is it clear to everyone? Anyone, any question? Response is mandatory. Response is mandatory. Good. All right. Let us proceed further. Just 1 minute, please. Students, the question is how these standards are developed. These standards, how these are developed. IAASB standards. We talked about ISAs, ISQCs. Come to the notes. So you need not, you see, these are different standards issued by IAASB. I told you now. So I don't know, some sort of, there is, I think, formatting issue. Development of IAASB standards. How these standards are developed. So the process used to develop ISA, the data standards, is called due process. Due process. Whenever they have to develop a new standard, they form a committee. IAASB, the board, they form a subcommittee, which is called Project Task Force. Do research and bring a new draft standard. They go and they bring that draft. And then a meeting is held where debates is done. Okay, this new standard, its benefits, its downside, its upside, etc. They say that. Now, the next point is, then it is published for public in the magazines, the journals, and the public comments are invited for 120 days minimum. For 120 days minimum, their comments are invited. And then comments are considered. Yes. And it is revised. Standard, draft standard is revised. I repeat. First, project task force is formed. They do research, bring a draft standard. Then a meeting is called, open for public, comments, debate is done. Then it is published for 120 days and people are in different magazines, different journals, and comments are invited. Then comments are considered in a meeting and it is revised as necessary. And then affirmative approval. Then after comments, it is amended and then IAASB board meeting is called. At least 2/3 member of IAASB give its approval and it becomes a new standard. Now, the student, it is done. Only one topic is remaining: rights of auditor and duties of auditor. From this chapter, just a minute, let me open the course plan. What is the task for today? The task for today is regulatory environment for, okay, it is almost complete. Then we have to proceed with overview of audit, acceptance of audit. Good. Control introduction. Very good. And financial statement objectives. Right. Okay. Now, let us proceed further. So students, the rights and duties of auditor. What are the duties of auditor? The auditor's main primary duty, fundamental duty is to report on financial statements. Check financial statements, form opinion, and issue report. And in order to do this, he has a duty to check. Now, these are required by law. Required by law. Again, this is primary duty. And in order to do that, subsidiary duties. He has to check the company has kept adequate record, accounting record. Company is in compliance with law. Directors' remuneration, emoluments, they have been properly disclosed. And the next is accounts are in agreement with underlying records. Excuse me. Accounts are in agreement. Accounts and record. Record is, for example, GRN, GDN, and other things. And then returns have been obtained. Yeah, during the audit, auditor need to ensure that if I am unable to visit all the branches of company, the branches I not visit, I should obtain the returns and accounting record and review that. I have to make it sure. So these are the duties of auditor. In order to perform these duties, student, if there is any confusion about any point, you can ask me. I'm ready to re-explain, please. I'm ready to re-explain any point which is not clear. Okay? Tell me. Emoluments are benefits, salaries, bonuses. They are all collectively called our emoluments. So auditor has to check director salaries, benefits have been correctly disclosed. Any other point, please? Any other point, please? A student asked emoluments, I explained. Is it clear so far? If there is not clear, do ask. I'll proceed and complete the statutory rights. Statutory rights. In order to, statutory means legal rights allowed by which the law allows auditor to have rights. That auditor has a right to access accounts and books, all record of the company. Right to obtain information, explanation, whatever is required for their duty from the company's officers. Right to attend general meetings, means shareholders meeting, and receive all notices which are sent to shareholders. Right to speak at general meetings. Shareholders, they have the right to talk to shareholders in the meeting. Right to receive any resolutions passed. So you need to memorize all these points. Now, student, this chapter is complete as well. This regulation of audit. Now we have to proceed towards the overview of audit process. Yes. But before that, I will take only 5 minutes break. Okay, so 5 minutes break. I normally take small breaks, maybe 2 or sometimes 3. That so that we can have a fresh mind before we proceed. So see you in 5 minutes. Yes, students, now we have to discuss the overview of audit process, and this is very important topic. This topic which I'm going to discuss, it is going to be utilized in the next 10 lectures minimum. The topic which I'm going to discuss now today, in the remaining lecture today, it is going to be utilized, I'm saying, in the next 10 lectures overview it is. Now listen. Auditor comes to the audit, and we know that auditor's role is to report on financial statements of company. This is the ultimate target and objective. This is the ultimate target and objective, that whether financial statements have been prepared correctly or not. And in order to report on financial statements of company, what auditor has to do? Auditor has to, in other words, auditor has to plan to perform work on financial statements of company. No, don't note it down yet. I am just explaining. Focus just on the explanation. I will give you time to note it down. First understand. Because I am doing a backward engineering of the topic. How to perform work on financial statement of company. First of all, to detect misstatements. Misstatement means if the things are wrongly recorded there. And then on the basis of that, auditor gives audit report. First, he performs audit work on finance statements. Or in other words, number one, you said to detect misstatements or to verify financial statement items. Same thing. And on the basis of that work, auditor can give audit reports. Next point. The next point is, now how misstatements are, no, how much work, the point is how much work auditor need to perform on financial statement. The question arises. So what does auditor do? Auditor financial statements are prepared by the company. Remember, financial statements are prepared by the company through a process which are called controls of the company. Which are called controls of the company. So if the process is not good, it means there will be a lot of misstatements. If the process is good, it means there will be a few misstatements. In other words, the company has adopted a good system to produce financial statement. A sound system to produce financial statement, there will be less misstatement. If the company has not adopted a good system, a weak system, a poor system, there will be a lot of misstatement. So then auditor has to perform work accordingly. So auditor tests the controls of company. Controls of company. Controls or control system. And on the basis of that, he decides how much audit work he has to perform on financial statements. I ask you, don't note it down. Okay, just understand. And now, how auditor has to test the control? Means, first of all, he need to understand the control, the company, which controls are likely to weak. So auditor has to check, do audit planning and risk assessment. Now you see here. Basically, this an acceptance of audit. Before that is acceptance of audit. You see that the points are moving like this. First, second, third, fourth, and fifth. But it does not move like this. I will explain it. Now what I will write, you will write that. Starting again. Student, this backward, which I have linkage I have explained. Is it clear to you people? Tell me. Don't note it down. Tell me, is it clear? Okay, note it down. Note it down. This is overview. This is brief overview. Brief. I will explain it. Note it down, okay? Note it down, okay? Then I will go and I will elaborate it further. Although I don't want you to memorize it, I will elaborate it further in a few minutes. You can note it down. Now, next. Should I proceed further? Have you noted it down? Should I proceed further? You can open the mic and talk, please, yes or no. Means typing takes more time, I think, than uttering a word. Now, so students, once again, the same process, but with more explanation. Yes, this you need to prepare, which I'm going to start now. Auditor comes to the company, auditor accepts the audit. Then auditor performs audit planning and risk assessment. And during that, auditor assesses whether internal controls of company seem to be working or not? Internal controls to prepare financial statements. They seem to be working or not? Now, two answers may be there. One, two. Two answers may be there. Seem to be working? Yes. No. Two possibilities are there. If now you can note down this along with me. You can note down this along with me. Okay? This is what you have to prepare. The previous one was just a vague overview, just to start with. Now, the next point is internal controls. If they seem to be working, the point is no. It means there are a lot of misstatements. Misstatements means items wrongly recorded. Might be present. It means that in financial statements. Might be present in financial statements. Now, so it means they need to perform detailed audit work on financial statements needs to be performed to detect misstatements. And student, that work, the work on financial, I write on a site, work by auditor on financial statements to detect misstatements is called substantive test. Is called substantive test. Students, if you are unable to note down anything, sometime it may happen. Don't hesitate to ask me to scroll up or scroll down, scroll right, scroll left. Okay? I will show you. I'll be happy to show you the work which you have missed. Now, next, let us proceed further. Let us proceed further. Students, if they seem to be working, Controls seem to be working. Perform detailed, perform test of controls. Test of controls to check controls are actually working or not. Because if they say yes, seem to be working. So perform test of controls that actually they are working or not. So perform test of controls. Now two possibilities are there. Controls are not working. In fact, so again, detailed audit testing. Same thing. Because there are a lot of misstatements. If they are working, controls are effective. So less audit work, which is also called on financial statement. It is called substantive test. I already told you. Less substantive tests required. Less detailed substantive tests required. And then afterwards, review stage of audit, and then audit report. Audit report. This is the audit process, overview for audit process. I hope it is clear. Overview of audit process is clear, I hope. Now, then is acceptance of audit. Okay, we will start with that. Then control introduction. Okay. Let us start with audit, acceptance of audit. Students, you see here, second, so this is the audit process, the full, you need to, this all should be on your fingertip. This audit process should be on your fingertips. So starting with the acceptance of audits, the one by one now. Whenever an audit, a company approaches auditor, whenever a company approaches auditor to get its financial statements audited, auditor does not accept the audit immediately. Rather, auditor consider relevant facts and identify issues. And now issues. The issues may be of two types. First of all, they are resolvable, not resolvable. Resolvable, accept, resolve and accept. And accept the audit. Not resolvable, reject the audit. Simple as that. Now, issues may be of two types. Issues may be of two types, which has to be considered. The one is auditor related, which are also called practitioner related. The other is client. Client means the company, which has to be audit issues. Now, one by one. Auditor related. Auditor has to consider, first of all, whether qualified to act as auditor, whether the law allows auditor whether auditor has qualification as per law to audit the company or not. Whether qualified to act or not. Yes. Next point. Second, resources available. For audit, now resources are of three types. Skills, competence, in other words, to perform audits, that specific company. Second, experience. And the third is audit staff. Sufficient team members available for audit of that company or not. 1, 2, and third, ethical issues as per code of ethics are considered. Self-interest, self-review. You have studied in F1. We will be studying in F8 in audit and assurance. So any ethical threats which are there? Now, let us proceed further. Client-related issues, what they are. Client-related issues. Number one, client screening is performed. What is client screening? Information is obtained. Who are the managers? It is also called due diligence. It is also called know your client. Who are the managers? What is their repute? Who are the finance provider? Who are the owners? What is the nature of business? What is the reputation? What is the history of the client? So this is all is done. All is done. So client related issue, that whether we should accept this client or not. And the second thing, references are obtained and verified. References are obtained and verified. So you obtain reference. You obtain reference that give us some information. Who can give information about you? You want to be our client? Okay, we want to verify information about you. Tell us who can provide information about you. So references are obtained and verified. And then communication with outgoing auditor. We contact the outgoing, the auditor which are not going to be the auditor now. They are going to resign, they are going to leave. So we contact with the outgoing auditor and get information about the company. And ask them why you are leaving this company. Why you are not going to continue as auditor. Are there any reason that we should not be their auditor? And if the company, and of course, this contact is done with the permission of client. For example, Coca-Cola is the company. We are going to audit Coca-Cola. And Coca-Cola does not allow us to contact with them. We cannot, we say, okay, sorry, if you don't allow us to contact with your outgoing auditor, if you don't allow us to contact with your outgoing auditor, we cannot be your auditor. Sorry, goodbye. Or in any other way, Coca-Cola prohibits the outgoing auditor to provide information us. We simply decline audit. So this is the issues to be considered. And of course, this information is being get before acceptance of audit. Before acceptance of audit. It is done. Next. Okay, we are satisfied with all above. Now, student, it is just like that. You say, Mr. Hamzah, teach us, come to Mauritius and deliver a lecture on audit in our firm. I say, okay, I will come. But where to conduct? Have you arranged any hall, lecture room, some projector, some board, some writing pad? These are the basic requirement to conduct a session. They say, sorry, we cannot arrange it. So can I conduct a session without that? I cannot. There's a precondition. Although we are agree on that, I should come to your lecture initially. I'm satisfied with the initial work. But the point is, there are some preconditions for audit. If those preconditions are not present, I cannot proceed with the audit of the company. I cannot. Yes. What are the preconditions? Preconditions are those conditions, if they are not present, auditor cannot audit the company financial statements. Two preconditions are there. Number one, Financial reporting framework being used by a company, by client, is acceptable as per law. If not acceptable, we cannot audit because that is something against law. And financial statements are crap. No use of that. And the second point is here. Management of clients understands and acknowledge the responsibility about three things. Preparation of financial statements as per financial reporting framework. As per financial reporting framework is their responsibility. Yes. Second, implementing a control system in company is responsibility of management. Is the responsibility of management. Next, third, they will provide management will provide unrestricted access to all auditor, to all record and information required for audit. These three. So basically 1 and 2 preconditions. If any one of these preconditions is missing, auditor simply can say, sorry, I cannot audit. Right of auditor. That is the right of the auditor. Yes, you say that. All right. Now, next, the next point is, students, is it clear so far? Preconditions and pre-acceptance. Tell me, these things are clear? If any one of them is not present, if any one of precondition is not present, what will happen? Auditor will not accept audit. Auditor will not accept audit. Now, next, let us proceed further. Students, once things are decided, now come to the notes. Enough we have written. So let me take you to the acceptance of audit. Don't know what happened to this alignment of the pages. I have discussed all these with you. Preconditions. Now, so once auditor is satisfied, it is the page number, if you see, it is the page number 35 of notes. Now, auditor is satisfied with the precondition. They sit down with the management and decide terms and conditions verbally. And once terms and conditions are decided, they are put in letter. That is called engagement letter. And then the previous auditor is removed and new appointment. So auditor need to make sure all legal formalities are done. What is engagement letter? Engagement letter has these 5 mandatory content. Basically, engagement letter is terms and condition of audit. Terms and condition. What is my responsibility being auditor? What is your responsibility being management? So that there is no ambiguity. So engagement letter, the first thing is objective and scope of audit. Scope means areas of financial statement to be audited. What is the work I have to do, whether it is legal required audit or not, statutory audit or not. What are auditor's responsibilities? What are management responsibilities? What is relevant financial reporting framework? For example, IFRS, whichever it is. What they expect from me being auditor? They expect in the form of audit report or something else. Additional matters that can be included but not limited to. You see here, you need not to memorize this. Remember, in engagement letter, whatever auditor wants, the purpose is clarity of terms and conditions. Whatever auditor wants, whatever management wants, that can be included in engagement letter. Now, so recurring audits. Recurring audit. What happens in the recurring audits? Actually, you know what happens? For example, I got appointed as auditor of company. I got appointed as auditor of company in 2021. I submitted an engagement letter. The company wants me to audit 2022 as well. Okay. So should I submit an engagement letter again? 2022, 2023, 2024, every year, new engagement letter? No, not required. The same submitted here will serve the purpose for the foreseeable future, unless some circumstances arise, unless some issue, such issue arise that engagement letter is revised. What are those issues? The first is that there is misunderstanding between objective and scope of audits, or they are going to revise terms and condition of audits. Senior management of company change, company's shareholders change significant, then engagement letter has to be revised. Company's business change, size change. So when size and business change, scope of work is changed. So engagement letter has to be revised. Laws and regulation change, financial reporting framework change, or they want auditor to report further matters, different matters. So if any one of this occur, engagement letter has to be revised. Engagement letter has to be revised. So then, now, any confusion, anyone? Any confusion, anyone? Any point you want me to re-explain? I am ready. Yes, please. All right. Now, students, let us have a 5 minutes break again. And after break, we'll be back. We will continue with the next topic. So see you in 5 minutes. Yes, everyone now. Next, the next is topic is I told you the overview of audit process, right? So audit planning, we are not doing that. We are directly shifting to the controls. Why? Because in the planning, all this wording, substantive tests and control, this wording has to be used. So that's why we will, and you will not be able to understand that wording and the terminology unless we are clear about this. Yes, these topics now. So students, what are the controls? Introduction of control I will talk about today. Just 1 second, please. Right. We have time. Good. Student, first of all, example. It is hot weather here in Pakistan these days. So what we have? We have turned on aircon in my room to keep temperature at the moderate level. It is a control. Aircon is a control. I know it is winter in Mauritius. You are wearing some jackets to stay warm. It is again control. You are having some soup, hot, you know that, coffee to stay warm. It is control. There is some objective. There is some purpose. Purpose. It is also called objective. You have to achieve it. Some practical way. Practical step. And that practical step is called control. This is called objective. So control and objective, which comes first? Control or objective? Tell me. Which comes first? Controls or objective? Tell me. Is it a difficult question? Objective come first or control? Exactly. Controls are there to achieve objective. If there is cold, or I give you, it is raining over there, rain, and I give you umbrella, which is broken. Although it is a control, but control is not achieving objective, not protecting you against the rain. What you are wearing, your dress, that will become wet because of the rainwater. So control is not working well. Objective is not being achieved. Control is ineffective. So objectives come first. And then controls are there to achieve those objectives. Now, so students, so definition of controls. Internal controls or simple controls are the procedures, ways used by organization to achieve its objectives. Yes. Now, I repeat, with the example of company. The company has with camera, CCTV camera working, a security guard, locker. These are all controls. Objective is security, safety, authorized access. They first decide it. Okay, everyone should not be allowed to the cash department. So there should be thumb impression scan, biometric, card swipe. We should have, everyone should be safe and every movement should be recorded. If there is some illegal movement, so camera should be there. So objectives come first and then controlled. Financial statement should be prepared properly. Sales should be recorded timely. So there should be sales invoices, daily processing. Sale invoices should be sequentially numbered. So they are the practical steps to achieve organizational objectives. Now, students, I hope the introduction of the control is good. Now students, we are auditors. Organizations have different objectives. Our focus is financial statements. Financial statements. So there is a concept of financial statement assertions. What is financial statement assertions? I will discuss this topic multiple times with you and different aspects. And this is such an interesting and such a vast topic. So first of all, I am discussing it today. Those who have studied the subject before, I'm sure they are going to discuss, they are going to study it in different way today. I'm sure. So financial statement assertions are objectives of financial statements to be achieved by a company while preparing financial statements. Yes, objectives of financial statements. They have to be achieved. Excuse me. Now, objective of financial statements, what they are. For example, they say there should be completeness that there should not, nothing should be missed. Every item, okay, just a minute. Objectives are of two types. We can categorize. Assertions related to account balances. Assertions related to classes of transactions. Account balances. Completeness assertion. What is completeness assertion? Related to account balances. It is an objective of account balances that what should have been. This is objective. Recorded in account balances have been recorded. This is the objective management want to achieve. Means nothing is missing. And completeness related to transactions. Account balances are normally balance sheet items, and transactions are related to everything: sale and purchase, expenses, the transactions. So what should have been reported? Transactions are reported. Should have been reported or recorded. Again, have been recorded. Completeness assertion. It falls under both. Assertion related to account balances and transaction, both. Valuation and allocation. This is the object. I'm telling this objectives have to be achieved by management. That assets liabilities have been properly valued. Yes, this is the objective to be achieved. And here is the accuracy. Transactions have been properly recorded at correct amount. At correct amount. It is valuation and allocation for account balances and for transactions and events. And events. Events are also sale and purchase, you know that, or expenses. Now, next. Here, existence. I'm again saying these are objectives to be achieved while preparing financial statements. Existence. All account balances actually represent assets and liabilities. Means they are not fake. They're actually present. And here is occurrence. Transactions reported actually occurred. Yes. You see here, These are the objectives to be achieved. There are only those should be reported which actually occur. Next, rights and obligations. Company owns assets and owes liabilities. Any asset secured against loan have actually been disclosed, properly disclosed. Now, it means that they have actually disclosed everything properly. Next, here, cutoff. Transactions have been recorded in correct accounting period. In correct accounting period. This year, transactions have been recorded in this year only, not in the next year or not in the previous year. And this objective has to be achieved by the company. Then classification, it falls both sides. It falls both sides. Transactions and events and assets, account balances, they have properly classified among different accounts, face of financial statements as well. Next, presentation and disclosure. Again, it falls under both here as well. All the disclosures related to transactions and events and account balances have been given as per IFRS. All the disclosures related to them have been given as per IFRS and laws and regulations. Done. So I have told you one thing. Assertions are objectives of financial statement which are achieved to be achieved by management, and management implement control to achieve them. They are objectives of financial statements. Is that clear to everyone? So students, now we have basically shifted to the control section, which is starting from here. I don't know why they have disturbed my alignment, my coordinator. He has disturbed everything. And I'm so much embarrassed to see the condition of my notes. Anyway, it is starting from here, from the page number 57. Okay. So students, I would suggest you to read it at home. This one, page number 50. And now what I have told you, page number 57, 50, note down please pages, 57, 58. Rather, you can see from 57 to page number 63, you have to study at home. 57 to 63, more pages I will tell. Note down, please. (33) to 36, 33 to 36, 57 to 63, and more. You have a lot to do this in this week. I'm telling you, you have to do it. Please don't come unprepared to my class. I'm warning you. Yes, please. I'm a bit strict in this regard. Last week, I don't know whether you have prepared last lecture or not. Please prepare that. This week lecture, I'm telling you, this is starting from this page. Then is page number 10 to 14, 33 to 36, and 57 to 63. (16) pages around there. You need to prepare these well. Prepare these at home. Everyone. In the next class is the backbone of control area. Control section I'm going to discuss. And in the next 2 to 3 classes, we will be doing an area which is 2 classes, I think. In the next 2 classes, we'll be doing an area which is basically we have to, what we can say, which is around 25 mark weightage in your paper. And so before coming to next class, prepare these. Okay, students, is that clear to everyone? I have done today's task. God bless you. See you next Saturday. And those who have not enrolled yet, kindly enroll. Drop a text to our official number. You will get all details for enrollment. See you. Take care. Goodbye. Goodbye.
Goodbye.
Goodbye.